Hello everybody, my name is Mark. It has been a while, but welcome to another one of my investing videos. And in this video, I am going to talk about how to manage your option callers, at least the way I do it. And I'm going to talk about US Steel. If you watch my videos, you know that that's my main holding right now. And so here we go. This is my setup. And I did a lot of stuff on Friday, and I haven't had much to do videos about, but now I do because Steel came out with their quarterly earnings report, and they beat the estimates, but the earnings was good, but they still went down, and there's a couple reasons for that, which I will talk about that in a minute. So first, let's go over my current position. So here's my position right here. I own 200 shares of Steel, which I bought all the way back on March the 12th. And then down here are my options, and right here I own 6 put options, strike price $10. They're leaps. They expire January of 2021. And then the 2 calls you see, I have 2 long calls and 2 short calls. I have an option spread going on, and I did that because Steel bottomed out a few weeks ago, but it did not continue to go up past 16, and so I thought that would be a very good time to open a spread. And so it's kind of like a trade within a trade. And let me go to my transactions so that you can see where all the fun is, and let me put in ticker symbol X, and let me go all the way back to March, and this will show everything here. So here's where I first entered into all of this nonsense, and I bought 200 shares of Steel, and the reason why you see 2 separate orders there is because of a mouse click. I accidentally canceled the order, but 35 shares got filled, and so that peeved me off, but it is what it is. I got the 200 shares, and my dollar cost average is $20.66, and then I started out with $20 puts. 2 of them spent $3.99 a contract, and then Steel started going down, and so I started selling puts and opening new puts, and so I sold to close those $20 puts right here, and then I bought to open 15s right here. Steel kept going down, and so I sold to close the 15s right there, bought to open the 13s. Steel kept going down, so I sold to close the 13s. Where's that at? Right here. And then I bought to open the 10s, and that's where I stand right now. I bought 6 of them, and Steel finally bottomed out and started to rebound. And here, right here, is a covered call trade that I did. That was my last video, and I made about $180 on that, and that lowered my dollar cost average as well. And so right here you see that I bought at $13.14, and then I sold those at $14.94, and so I made a nice profit there. Took a small loss on the short calls that I was selling, the covered calls, but you're always going to make money on a covered call trade whenever you sell the open calls and the stock price goes above the strike price and the shares get called away. I think a lot of beginning option traders don't understand that, and they think it's a bad thing for the price of the stock to go higher than the strike price of the calls, but that's not true. That's actually what you want. Okay, so that's what I did there. And then down here is where I opened my spread, and I bought the $15 calls. And again, those are leaps, spent $3.92 a contract, and those expiring in January of 2021. And then I started selling to open calls. And so here I sold 2 $15.50 call, 52 cents a contract, took in $102, and then I bought to close those for $6, made a nice profit, and then I sold to open 16s, took in $55, bought to close those for $10, made more profit. And then just last Friday, that would have been on August 2nd, today is August the 4th, that's where I stand right now. Now I sold to open 15s, and those expire in the middle of September. It's about a month and a half from now. And then the other thing I did in my Schwab account. This here is my Schwab account, and I also did this on Friday. And let me go to my transactions here so that I can show you where are the transactions here. Here they are. Let me go to my transactions and I'll show you what I did. I sold to open 2 put options on steel right here. Sell to open, put US Steel quantity 2, and those expire also in the middle of September, same time as my short calls. And I got 53 cents a contract, and those are $12 strike prices. And so I took in $99.73. And the reason why I did it in Schwab is because I wanted to add risk. I don't want to add more risk to my Roth. This Ameritrade over here, where are you at, Ameritrade? All this here, Ameritrade, this is my Roth. And I want to increase my position in steel because steel's down, and I like to buy low and sell high if I can. And I also like to trade patterns, okay? And if you look, this is the pattern of steel. And this circle that you see right there is right where I bought. And I made an upper margin and a lower line, the resistance up here and the support. And so steel has been going down from my dollar cost average, but if we go back to my transactions here, if you were to add up all of the red numbers and all of the green numbers, then you will see that I made a nice profit of $993.49 plus the $180 and some change that I made on the covered call trade. My dollar cost average, which began at $20.66, is now all the way down to $14.84. Okay, so that's exactly how you want to play this game, is that when you buy a stock and the stock goes down, you want to protect the value of your stock. And the way you do that is by buying put options on the stock, because put options are contracts to sell your stock, and if the stock goes down, the value of your puts will go up, and you can sell to close those for a profit, and that profit will help to lower your dollar cost average. Okay, now steel came with an earnings, and I read some articles on steel, and this is TradingView right here, and there's in TradingView.com will show news, and I've read these articles why United States steel stock dropped 9% today, and here steel has been slammed this year. It happened again on Friday. That's just a couple days ago. And, I've read most of these articles here, and the general consensus, here's another one, U.S. Steel sinks after doubling down on spending amid cash burn. And that's really the skinny of this company, okay? Steel beat the estimates. Steel came out with 45-cent earnings per share. The predictors, whoever the powers that be, thought it was going to be 40 cents a share. And so they beat the earnings, but steel has been making investments, and even though their profits have been good, their debt has also been rising, and so that has got a lot of investors spooked. And so when you combine that with the fact that President Trump came out with some new tariffs on China, steel went down 8.61%. Now, if the tariffs hadn't done that, steel probably still would have went down. Maybe not as much as it did, but it still would have went down some, maybe 4% or 5%. But the point is that when the stocks make a move, that's the opportunity. Those are your opportunities to do something and to take advantage of those movements. Okay, you want to find stocks that are volatile like this, because that's where the money is. You do not want to buy and sell boring stocks that never move. You're not going to make any money. The only way you're going to make money is to find stocks that move. Now, ideally, if you had a crystal ball, then you would buy puts if you knew the stock was going to go down, or you'd buy calls if you knew the stock was going to go up. But since you don't know that, at least I don't, then I'm a hedger. Okay, I don't use chart patterns. I don't use technical indicators, oh boy, the price of steel went below the 200-day moving average or went above the 200-day moving average, it's time to buy. I don't do that. I don't believe in that kind of stuff. And there's all sorts of holy grails and secret formulas that if you just use the Ichimoku cloud, you should Google search that. There's a whole genre that believes in the Ichimoku cloud. I know most of the different ways that people use to try to make trades and try to get the right guesses, but my personal belief is that when you buy a stock or a call or a put, it's going to do one of two things. It's either going to go up or it's going to go down. And that is a 50-50 chance. So since you already know ahead of time that the stock's going to go up or down 50-50, heads it goes up, tails it goes down, then the idea is that when you're right, you want to make money. When you're wrong, you're going to lose money, but make darn sure that if you lose money, the losses will be smaller than the gains. And that's where all the options and the leverages come in. Because when you buy a call, for example, and this is the reason why I like spreads, okay, if we go back to Ameritrade, and we'll just go ahead and look at steel, and we'll look at some of their options, and I'll show you what I mean. Okay, and let's say I pick an option 74 days out, and let's say I buy this $13 call. It's going to cost me, the bid is $137, the ask is $144, so let's say $140. Okay, so let's say I buy this call, and then the price of steel goes all the way down to $5 a share. Okay, of course it's not going to do that. At least I hope not, but let's say it does. It goes down to $5 a share. Now, if you bought 100 shares of steel, then you would lose $8.27 a share. You'd be down $827. But if you buy a call, then you're going to lose $140. So just the very action of buying a call is a form of risk management, because the amount of money that you're putting at risk is a fraction of the cost of the amount of money you're risking when you buy 100 shares of the stock. Okay, and that's called leverage. And I like to use stock options to leverage myself. And the option callers is a nice way of leveraging yourself when you buy 100 shares of a stock and then you buy puts, because puts are contracts to sell the stock. And so what you do is you buy a stock, let's say at, and I'll just come up with arbitrary numbers here. Let's say you buy a stock at $10 a share, and then you buy a $9 put option, and that $9 put costs you $200. Okay, you're going to have an upper margin and you're going to have a lower margin. Your upper margin is you want to make back the $200 that you're spending on that $9 put. So in order for you to make money, then that $10 stock, if it goes to $12 or higher, you're going to make a clean profit. Now, if you buy a $9 put and you spend $200, and that means if the stock goes down to $7 or lower, you're going to make a clean profit on the puts. And that's how you come up with your upper margin and your lower margin. Okay, now let's go back to my position here, and I'll talk about my upper margin and my lower margin. Now, I did buy these 6 puts. Okay, so even though my dollar cost average is $14.84, let me go back to my transactions here, and let me go back to ticker symbol steel, and let me put in March like this. And so if you were to add up all of these numbers, starting from this number right here, I'm not going to count these numbers because that's my position. That's my 200 shares that I'm counting for the dollar cost average. So I start from where I bought the puts, and then I go all the way down here. And if you were to add up all of these numbers all the way until right here, I don't count this and I don't count this because that's a covered call trade. Okay, so if I just go down to where I sold to close the 13s, and I made a profit, and just take a look. Okay, I bought to open these 4 $13 puts for $1,195, and then I sold to close those for $1,409. Right, so that's like a 200 and change, little bit of change profit, and I've been doing that the whole time. Bought to open these 20s, spent $806. Sold to open the 20s right there. made $1,151. So that's a profit, right? And then bought to open these 15s for $864. And then down here you can see I sold to open the 15s for $12.35, made more profit, and my total profit on all of those was $993.49. So that's why I get to lower my dollar cost average all the way down from $20.66, and also the $180 profit that I made on the cover call trade when I bought to open those 200 shares at $13.14, and then I sold to close those at $14.94. So initial investment $26.34.95, and then the profit $29.80, and then took a small loss. I made about $180, and so all of that lowered my dollar cost from $20.66 all the way down to $14.84. Okay, now I chose, and I did this. You don't have to do this, but I felt so inclined to continue my option collar, and I bought the 6 puts, $10 strike price at $2 a contract. So including commission, I spent $1,211.55. And so that means in order, my upper margin is the $14.84 plus the $1,211.55. So I have to make, steel has to go to $14.84, plus I have to make this extra $1,211.55. That's about $6 a share. So that means steel has to go to $20.84. So about, if it went to $21 a share, then that would be my upper margin, right? So if we go back here, then steel has to go right about here, $20 and like $21 a share, right about there. So it's the same. It's about the same there. So that's my upper limit. That's because I bought so many puts. Okay, now my lower margin is my break-even price. Now my break-even price on the puts is 10 minus 2 is 8. So if steel goes down to $8, then I start making money intrinsic value on the $10 puts. Now the $10 puts, I spent $2 a contract, but if we look at my puts, if I go back to my positions here, steel is at where is it at? Steel's at $13.35 a share, and the puts are worth, the bid is $160, the ask is $171, and let's look up the delta on the puts. So let's say those $10 puts are worth $1.65, $165 a contract. Now let's look up the delta on the puts. You can use delta to figure out what your lower limit is. Okay, so let's go to the leaps, and this is my put right there, and let me put in Greeks like this, and then let me click on put like that. Where is it at? Okay, let me go to put like this, and then let me do this. Okay, and it looks like the delta is showing a negative 21. So, and the reason why it shows negative is because it's a put. If it was a call, then it would just show a regular number. But just know that the delta is about 21 cents for every dollar that it goes down. Okay, so remember that number, 21 cents. So $21. That means if steel goes down $1, steel goes down to, let's say, $12.43, then that means that this put will be worth 180 something, 165, 186. And so if it went down another dollar, then it would be worth 186 plus 21 is 207. So I would be in a clear profit if steel went down to $11.43, and that's not even counting this gamma. The gamma tells you how much the delta is going to go up for every dollar. So when if this stock did go down $1, then this delta would go up to 24. Okay, and that means that if steel went down to 11, then I'm getting all tongue-tied. If steel went down to $11.35, then the prices of the puts would go up in value a total of $24 because of the gamma. But keep in mind that if it goes down another dollar, then the gamma is going to go up. Okay, I mean, look at the gamma. If we go up to a 13, the gamma is up another dollar, right? And look how high the gamma is here. So as the value of steel drops, the value of my puts will go up, and my lower limit is about $11.50. Okay, so if it actually went down to $10, that's $1.50, by the way. That's another $24, probably $25, which means the puts would be worth about $240 a contract. I got 6 of them. I paid $200 a contract, so that's 4. I'd be $240 of a clear profit, even though they're $10 puts, and steel's at $10. They wouldn't be worth it. They wouldn't be worth any money in intrinsic value. All of the profit would be in the theta, in the time decay. And that's because these puts don't expire until 2021. So when you set up an option caller, and now that I've rambled all that, and I don't know how anybody in their right mind is going to keep up with all of that talking that I just did, but now this is the part of the video that I'm going to speak nice and slow and clear. Okay, when you set up an option caller, you're going to buy 100 shares or 200 shares or however many 100 shares of your stock, and then you're going to buy the same number of puts, and then you're going to sell covered calls, and the covered calls will pay for the cost of those puts. Okay, now when you do that, you're going to have an upper limit, and you're going to have an upper margin, and you're going to have a lower margin. Your upper margin is the dollar cost average of your stock minus the money that you spend on the puts. For example, if you buy 100 shares of XYZ stock at $10 a share, and then you buy one $9 put and you spend $150 for it, then your upper limit would be $11.50. So you would have to add, and I correct myself, you don't subtract, you add. You add the value of the put you spend. So in order for you to make money, a clean profit, because you spent $150 on for a put option on a stock that you own 100 shares, then that means that the stock needs to go up $1.50. So $10, $11.50. That's how you do your upper margin. Your lower margin is, and it really just depends upon your taste. You can use Delta like I did, or you can go by the entire expiration and use the break-even price. If you're using a break-even price, then going back to our example, you buy 100 shares of XYZ at $10 a share, then you buy a put option, strike price $9, you spend $150. You could take the $9 strike price, subtract the $150, and that would mean that XYZ stock needs to go down to $7.50 a share because you spent $150 on that put. The put gives you the right to sell XYZ at $9 a share, so stock actually needs to go to $7.50 a share, because if the put expired, then you could exercise your put at $9, and then you could turn around and buy the stock back at $7.50, and that would be a clear $150 profit, but you spent $150, so that's why it's called break-even price. So if it went down to $6, then you would make $150 profit. If it went down to $5, you'd make $250 profit, and so on. Okay, so that's how you do your lower limit. So if you have any questions at all, feel free to ask. But the main point I want to get across in this video, number one, I just want to show you that I'm just a real live option trader. I'm not an expert by any means. I'm just an average schmo that has a little bit of money saved up that is simply trying to get ahead in his life. Hopefully I can become a multi-millionaire. Good luck to me, right? But I'm just an average person, and I like to share whatever knowledge I have with the world of YouTube, the world of cyber investors like me. And so I like to go over what I'm doing with my money, because I don't think there's a lot of people out there that do that. There's a ton of people out there that love to talk about, let me teach you 3 simple chart patterns. Just give me however many $100 a month, buy my day trading course. There's hundreds of those. But how many people do videos of their actual live trading? This is my Ameritrade account, and I do a lot of stuff, and I'm not afraid to talk about my losses either. If you watch my videos, you'll know that I used to do a spread on Microsoft, and all of that Microsoft MSFT, that's all Microsoft, and that was a diagonal spread I did. And I lost money on that trade, and I did a video on that. I'm not afraid of talking about my losses, but I like to go over my real money because I don't think there's a lot of people that do that. And so I like to do that. And two, I like to try to share any ideas or advice or tips or tricks or whatever, and kind of take the overwhelming feeling out of trading and investing that I think a lot of people have. I think that investing and trading is very simple, and you should take time to learn about stock options. I've done videos on calls and puts and the basics, strike prices, premiums, expiration, covered call strategy, option caller strategy, leaps, all that stuff. And it's worth your time to learn this stuff, because you can use options if you're conservative, or you can be really aggressive, and you could buy and sell naked calls and naked puts. You can do bull spreads, bear spreads, you can do butterflies. There's all sorts of stuff you can do with options. I mostly use options for hedging, but I am always trying to up my game. I'm always trying, and I really want to jump into the SPY, but I don't have enough money yet to go that road. I'm probably going to get back into Twitter. Last Friday, Twitter is a stock. The market went down, but Twitter didn't go down with it. Twitter just kind of does what it's want. I like Twitter, but I also like Steel because it's so darn volatile. I like volatile stocks, and so when you trade volatile stocks, then you can use options to kind of counteract the volatility, and you can make money in the long run on the premium, whether you're selling cover calls or option callers or whatever you're doing. So again, if you have any questions, feel free to ask. And that's it for this video. Thank you for watching, and if I do any more moving around with my money, any more option caller managing or whatever, or if I jump into another trade like Twitter, I still have a lot of, I don't know what a lot of money to you is, but I have a decent amount of money in my cash balance. I have all this money, and I'm always thinking, should I get into Twitter? And there's some other stocks I've been thinking about. I always think about the SPY. Nugget is another one that I like. So we'll see what happens. Stay tuned. Thank you for watching my videos, and I hope you enjoyed the video. And if you have any questions, feel free to leave a comment. I generally answer all my comments. So until then, I will see you in the next video, and have a good day. Thank you.